So you'll remember with our first part of this introduction to accrual accounting that businesses require balance day adjustments to be performed at the end of the accounting period. And there are 4 balance day adjustments typically that are recorded in association with expenses and revenues. And what we're going to do now is we're going to move on and look at the first balance day adjustment, which will be prepaid expenses. So prepaid expenses are expenses which have been paid by the business in the accounting period, but the business isn't going to receive the benefit for that payment until the next accounting period. So it's the end of the accounting period, it's 30th of June. We want to close off our accounts. We identify this particular expense as an expense that has in that account an amount that we haven't received the benefit for it. We won't receive the benefit for it until the next accounting period, but we have paid for it. So it's sitting in our account, and what we want to do is we want to adjust that amount so that that amount represents just the expense that belongs in that accounting period. So what kind of expenses can we expect to have prepaid? Well, insurance is a classic, because depending on when you take your insurance out, it could be like the 1st of May, and generally you pay insurance on an annual basis. So that 1st of May payment will last you until the following May. Subscriptions, perhaps subscriptions to events or subscriptions to trade journals, they can be taken out for a year, but you won't maybe have consumed the entire value of that payment within the accounting period. So these are all potential prepaid expenses. Here's an example we're going to look at. The business has paid $1,200 for a subscription to a trade journal at the beginning of March. The subscription account, which is an expense, would appear as is indicated here. So on the 1st of March, we've recorded here that we've made this payment of $1,200, and what does that $1,200 represent? It represents a subscription to this magazine for an entire year. So that subscription will end the following March. So let's consider some details here. So the subscription is for a year. We renewed it in March of 2008. So in 2008, it basically means that the subscription is going to expire, and if we want it to continue, we need to renew it next year. The balance day is the 30th of June of 2007. Any part of that subscription amount of $1,200 that has not been consumed at that point in time, at the end of the accounting period, is deemed to be considered prepaid. So it relates to the next accounting period. It's an expense that will help us generate a revenue for the next accounting period, so that expense needs to be matched to revenue in that accounting period. But it's sitting in the subscription account in this accounting period. So the prepaid amount is $800. I've worked out 8 months worth of the subscription because 8 months is prepaid. So remember we paid it in March. So we've consumed all of March, April, May and June. We've consumed 4 months worth of that subscription. 8 months won't be delivered until the next accounting period. So 8 months worth is prepaid. So the account on balance day has to recognise that prepaid amount because we will overquote our subscription expense account by $800 if we leave that amount out. That $800 has not been used in this accounting period. It's not been used to help us generate a revenue in this accounting period because it's a potential expense for the next accounting period. So how do we make this adjustment? Well, we perform a general journal entry and it looks like this. What we want to do is we want to decrease the subscription account, which is an expense account, by $800. How do you decrease an expense? You credit it. Something has to be debited, and we raise this account called a prepaid expense account. Now, if you think about the nature of that account, it represents an amount of $800 that we have paid for. We haven't received the benefit for it, so it is owing to us. We are owed this $800 worth of trade magazines. that publisher needs to deliver those magazines for us. We've paid for them, so that's an asset. That's why it's debited. That represents an amount that is owing to us. Not in cash, but certainly in services. Those magazines are owed to us. So let's think about what that double entry allows us to achieve. It allows us to decrease the subscription account by the prepaid amount. Remember, that was $800, and that general journal was that subscription account in the general journal entry was crediting the subscription account. And it also allows us to raise this temporary, in emphasis here, this temporary asset account that was called the prepaid expense account. And in it is sitting this $800 because it represents an amount that we've paid in advance. It's an asset because the business is owed the service of the subscription. Now it's temporary because in the next accounting period, it's no longer going to be an asset. The very next day, July 1, the beginning of the next accounting period, that asset is no longer an asset because it will no longer be owed. We will be receiving during that accounting period the benefit of that expense that we paid for last year. So it is only a temporary asset account. So let's have a look at how that double entry of the adjustment will look in the ledger. In the ledger we have the expense account here, subscription. You'll remember that we saw how on March 1 we paid for the expense of $1,200 here. That was for a full year. And then we perform that double entry to adjust that amount because 800 of that, 1,200, has been prepaid. So you remember that the General Journal quoted the subscription account is credited by 800. Look at the effect on the balance. It's decreased that balance down to $400, and that's exactly right. That's the amount that belongs in this account as a representation of how much we have consumed in subscriptions for this accounting period. To get that, remember, we've had to decrease the account by that adjustment amount. So ask yourself, we've just credited this account. What account was debited? And it was the asset account, prepaid expense. So that's what we write here. If we hop up here to the prepaid expense account in the assets section of the ledger, you can see the double entry. The account is debited by $800, debit balance, and in the particulars column we record what account was credited in the double entry. So that's how the accounts will sit after you have completed the double entry. Now what's important to note here is because this is an asset, it's going to show up in our balance sheet. That $800 will be recorded in the balance sheet at the end of the accounting period, and it needs to be there because it's an asset. We've paid for it, we are expecting to receive a service in return, and we will receive that service in the next accounting period. So it's going to sit in our balance sheet as an asset. This amount here, this $400, and you should realise this $400 in the expense account at the end of the period will be closed to P&L summary. Okay, so the very next day, we've had the end of the accounting period, June 30. We closed off our expenses and revenues. We've completed our balance sheet and income statement. Now it's the next day. We go into work. It's July 1. What we need to do is we need to reverse all of the balance day adjustments that we performed yesterday, June 30. We need to perform these reversing entries, and I'm going to explain why. The reversal of the balance day adjustment entries need to occur so that those revenues and expenses which were adjusted in the previous accounting period, they need to be returned back to their pre-adjusted state. And what it also allows us to do, this reversing entry, will also allow us to close those asset accounts that were raised so that we could perform the double entry in adjusting the expenses and revenues. And the asset account that we've looked at so far is the prepaid expense account. That account, remember I said the very next day, is no longer going to be an asset because it will no longer be owed to the business. We will receive the benefit for that expenditure that was made last year in this current accounting period. So that asset needs to go away now because it's no longer an asset in the business. So let's see how that happens. Here's the general journal entry. Now we perform it July 1, the very next day, the beginning of the next accounting period, and we need to reverse the double entry that was the balance date adjustment. So instead of, you'll remember that previously the double entry was prepaid expense debit, subscription credit, $800. Now we reverse it. Subscription now has to be debited $800 and the prepaid expense is credited by $800. And now we can have a look to see how that looks in the ledger. Here's my prepaid expense account in the assets section. You'll remember at the end of the accounting period, we had that subscription amount sitting in there representing the amount that was owing to us in terms of a service being owed to us. The reversal of that now, the very next day, closes that asset account off because we don't want that anymore. It's no longer an asset. If we look at the subscription account, the expense account, you'll see the details. You'll see March 1, way back last year, March 1, we took out the subscription in the first place. At the end of the accounting period, we adjusted the amount by the prepaid amount. We adjusted the account by the prepaid amount. At the end of the accounting period, we closed off the account to P&L summary, so it's sitting with zero. But here's the effect of the reversing entry. The account now is going to be debited with the prepaid amount, which is $800, and that's perfect. Because, remember, the reason why we took that amount away last year was because it belonged to this accounting period. In March, we paid $1,200 for a subscription, 4 months of which was consumed in the last accounting period, 8 months of which will be consumed in the current accounting period. So that expense needs to sit in the account in this accounting period because it will help us to generate a revenue in this new accounting period. So it belongs in this accounting period. So that reversing entry is useful because it brings this account back to its pre-adjustment state, brings that expense back into the account because it will be now consumed in this current accounting period, and it allows us to close off the prepaid expense account, which is, we'll not close it off, but to eliminate it because it's no longer an asset. It's being now consumed as an expense. So prepaid expenses are one type of balance day adjustment. They focus on expenses at the end of the accounting period which have been paid for but will not be consumed or we will not receive the benefit for that expense until the next accounting period. So we need to adjust the expense down by the amount that has been prepaid so that we leave a balance in that expense account that represents the expense for that accounting period. The very next day, we need to perform a reversing entry to return that expense account back to its pre-adjusted state so that that $800, for example, now is sitting in that account representing an expense that belongs to this current accounting period. And that's your prepaid expenses.